The broadcast is now.
Hi everyone. Thanks for joining us for today's portfolio construction webinar. Today we have Scott Fletcher presenting for us from Russell Investments. But before I begin, I'll just start off with a little bit of housekeeping. This webinar is being recorded and the slides will be sent to you after the webinar. We encourage you to ask any questions you have throughout the presentation, so please put them in the chat box. And if you're posting to social, make sure to use hashtag NetwealthInvest or tweet at NetwealthInvest. And today Scott Fletcher is presenting, and he is the Director of Client Investment Strategies at Russell Investment Asia Pacific, and he'll be sharing the key findings from the 20th edition of the annual Russell Investments ASX Long-Term Investing Report. I'll now hand it over to Scott. Thanks, Scott.
Great, thanks very much. Good afternoon, everyone. In the next 30 minutes or so, I'll take you through the highlights of this year's Russell Investments ASX Long-Term Investing Report. Starting with a look in the rearview mirror at some of the key findings from the report before we look ahead to draw out some implications for Australian investors, and particularly with regard to the ingredients for success in achieving outcomes in the years ahead. First of all, a brief introduction for those not familiar with Russell Investments. Russell is a global investment management firm headquartered in the United States. We have 21 offices across key global financial centres and geographic regions. We have a strong heritage as pioneers in the investment consulting industry, multi-manager investing, style investing, and multi-asset investing or diversified funds. And this stretches back almost half a century, and we've been in Australia since 1986. Since then, Russell's evolved into a global multi-asset solutions platform, and we've built out a range of capabilities and services, and we've combined extensive experience in asset consulting and funds management to advise on more than $3 trillion globally across blue chip client base. We do also manage $389 billion in client assets, as well as trade and execute more than $3 trillion through our 24-hour trading desk for not just our own funds, but also for actual large competitors and peers. Now, just to set the context on the long-term investment report a bit more for you, Russell has always been a research-driven organisation, and it's all about applying insights to the way that we design, construct and manage investment solutions. And our relationship with the ASX is part of a global research effort that we have to partner with quality organisations to glean investment insights in different regions. The Long-Term Investing Report provides an annual snapshot of long-term asset class performance for Australian investors, specifically performance outcomes for the last 10 and 20 years on a pre- and post-tax basis. Since we first started producing this report some 20 years ago, the range of asset classes covered has expanded as the quality of long-term data has become available over time. So as you can imagine, some 20 years ago, we didn't have some of the asset classes and sub-asset classes that we now do to build up a more fuller picture. Copies of the report are available via our website, russellinvestments.com/au, with details about benchmarks, assumptions used, particularly tax assumptions, and how we've constructed property indices and things like that. So that may be of use to you. So why worry about the long term? I think it's a good starting point, because often when we think about 10 and 20 year investment numbers and we do an annual version of a report for it, often the question that comes to mind is, well, does anything actually change that much? The answer is that the information is not just in the destination or the actual outcome or the return outcome number that you find for a 10 and 20 year period. There's actually far more information in terms of the journey along the way. So the year in, year out variation in asset classes. And when we look at long-term numbers and long-term analysis or return assumptions and so on, the past has an awful lot of information on how to design portfolios for the future. And it doesn't matter whether you're a retail investor or one of the largest institutional investors in the world. We all have to deal with the same inputs in thinking about what outcomes do we want for our portfolio. So this is in terms of designing in the investment process, the first design stage. What's the purpose of our portfolio? And this is all about the outcome. Do I want an inflation plus 2, 3, 4, 5, 6% type of outcome? Am I more worried about risk? Is it some combination of the two? Secondly, what is the right mix of asset classes? That's the next thing that flows from that. So not just what's my outcome, but how do I allocate between different types of investments to achieve that outcome? And then thirdly, and this is where things like the long-term investment report come in, it's how do we account for current market conditions? So one of the dangers in a late part of an investment cycle, which is what we firmly believe we're in at this point in time, one of the dangers that a lot of particularly retail investors can make is that they transpose what's happened in the past, over the past 10 years, and they put that into their thinking, or if they're advisors or actual portfolio management groups dealing with retail clients, they would just put those same sort of numbers, returns, risk, correlation sort of numbers, and assume that the world that we've seen for the last 10 years will continue for the next 10 years. And the problem is that it doesn't account for how expensive assets are. So return number is one thing, but it doesn't tell you anything about how much upside is left given the valuation or how expensive or cheap a particular asset class is at this point. So things like the long-term investment report are critically important, along with other research we do, in giving us a point-in-time snapshot to say, well, this is the last 10 or 20 years. This is the historical relationships we see between global shares, Aussie shares, bonds, fixed income, high yield, or whatever the case may be. But given where markets are currently at, this is how we will adjust those assumptions going forward. And that has a big impact on the sort of asset allocation you have for the next 5 years or the next part of the investment cycle. So just turning to the key findings of the 2018 report, Australian residential property outperformed all other asset classes for both 10 and 20-year periods. Now, this may not come as a blindingly amazing insight for those particularly living in Sydney and Melbourne, given what we've seen in the last few years. But the most recent 10-year period actually starts with the worst of the GFC, which we recall from 2008. And this was during a time when property experienced only a fraction of the falls in listed equity markets. And this explains most of the performance advantage over global equities for the past decade. So I guess you could say if equity markets behave themselves for the next 6 months, this could actually change the ranking of residential property quite meaningfully in next year's report, but obviously time will tell. If we extend the period back to 20 years and look at residential property, property in aggregate outperformed around the turn of the century when the tech bust hit global equity markets. So we recall about 2001, March 2001, was the tech bust after the previous years of significant stellar gains in technology stocks. In some ways, not dissimilar to elements of the tech market that we see today. But that's to say the return advantage of residential property over the long term, this 10 and 20-year period, is more about not falling as much when equity markets take a tumble than it is about stellar upside performance. Hence, property's place in a diversified investment portfolio. Now, if we move to the key findings for the 10 years, if we're looking overall at asset class performance for that 10-year period, Australian residential property, hedged global shares and bonds lead the way. Although if we're looking at hedged, the Aussie US dollar did decline point to point during that period, but was up significantly against the euro and the British pound, currencies like that. Also, when you hedge, you also pick up additional interest differential between Australia and, say, the US or other parts of the world, which was as much as 3 and 5% extra when you actually hedge back to Australian dollars. So that's why, despite a generally falling Australian dollar point to point, it was actually good for hedge returns during that period. Note also the ranking pattern you'll see in the chart is very similar regardless of whether we're looking at results in a pre or post-tax return terms. And you can refer to the report for the post-tax charts and assumptions on that as well. Looking through to 20 years, it's a similar ranking outperformance by Australian property. The only thing is that global share swaps places with Australian shares. So unlike the 10-year period when global shares, hedged or unhedged, outperform Australian shares in 7 out of the 10 years, which was helped by a lot of the tech and healthcare stocks, which are a larger part of the global indices. The 20-year period includes a strong run of local market outperformance in the aftermath of the tech bust that hit US and therefore global equities hardest. But again, you're still seeing that residential property outperforming. You're seeing equities come in very much in number 2 position. And despite the fact that we've had one of the biggest bond bull markets of all time, the returns that you see, which have been double digit at times from the bond markets, which is historically very unusual, particularly during the last 10 years, the returns you see from bonds still can't keep up with equities at their best. But that's what you see in a very volatile asset class like equities. So that's in terms of the destination. That's the big end result numbers or returns that we see. But the other key findings are all about the variability in returns. We call this the journey. So that's why we've subtitled the 2018 report as "The Journey Matters as Much as the Destination." And you'll see on this particular slide, we've looked at property, equities, fixed income, and multi-asset. On the property side, again, reiterates, it took the top spot, but in 2001, 2002, but also came in last below Australian cash and bonds in 04, 05. So you can see there is a lot of variation there in a year-to-year basis. When it comes to equities, global equities, hedged and unhedged, Australian shares and Australian listed property, which is really what we treat as a sector of the Australian share market. These rankings also fluctuated very strongly, fluctuating the most, in fact, taking both top and bottom spots year on year through the period. Fixed income side, global and Australian fixed income rankings were less volatile, which is very much what we would expect from that particular asset class, but still move around year to year, particularly between Australian and global fixed income. Multi-asset, that is a category where we've put in a representative sample of multi-asset portfolios, especially a 70% sample growth fund, so 70% growth assets, 30% defensive assets, which is fixed income and cash type of income producing assets. These portfolios are used as to juxtapose against the sort of wild swings and roundabouts that we see in individual asset classes. So that is to say, what's one way that we can address the variability in returns? Because it's one thing to think about the return that you need to generate to achieve your particular retirement objectives or outcomes or whatever the case may be. But it's another thing to think about, can you actually survive the journey along the way? In other words, can you stomach or put up with the volatility of your particular combination of assets or your particular portfolio? So the multi-asset portfolio comparison that we use, which you'll see in the following slide, is very much about the benefits of diversification in terms of you can still get to CPI plus 4 or 2 or 4 or 5 or whatever, but it's a much smoother ride thanks to the benefits of diversification across multiple asset classes. So the next slide, we look at the detail in terms of the past 20 years, and up the top you can see 1998 through to 2017, and up the top of this, let's call it a mosaic or a quilt chart. I'm struggling for a particular name. We look at the best annual performance asset classes up the top, and down the bottom is, as you would imagine, the weakest performance asset classes. Now, if we look at the top performer just in point-to-point return, as I mentioned, which is Australian residential property, you can trace out a pathway like the white line is showing. So you can see that even though in one particular 10-year period and one particular 20-year period it outperformed, there's a lot more information in terms of the actual journey that we see along the way. For example, residential property was top of the pops back in 2001, 2002, up some 20-odd% in 2002. But when you look at the shares, Australian shares, global shares, and so on, down the very bottom of those years, you can see that that's when we've had the aftermath of the tech bust. So again, it backs up my earlier point, which is residential property does have periods where it performs extremely well. But over the long term, more often than not, you'll find that shares asset classes or equities asset class exposures will generally provide much stronger returns. It's just that property, because of the nature of the property investment or as an asset class, doesn't fall by anywhere near as much when times get bad. You'll also notice in 2007, 2008 as well, during the depths of the GFC, we're seeing global shares falling by, on a hedge basis, by as much as 40-odd%, whereas residential property falls by 3%. Now, the thing to notice about residential property is the way we construct this analysis is we have to have a representative index. And this index is population weighted using Real Estate Institute of Australia data. But obviously, it's a lot easier to replicate an index or a share market index for an average investor than it is to replicate the residential property market of Australia, because you'd have to have some significant, dare I say, national size capital backing behind you to have that much diversification. So we just need to keep that in mind, that on a case-by-case basis, market-by-market basis, some markets in the property side will do far better than the numbers that are represented here, and some property segments or markets across Australia and even within a state will do far worse than what's represented here. But again, I could say that for stocks, securities, I could say that for fixed income securities as well. But this is just to give you a representative, big picture view of what's been going on. Likewise with the Australian share market, as we've traced out there in the orange, the dark orange, a very volatile time. So if you're sitting there with Australian shares over 20 years, particularly not so much the most recent 10 years, but the 10 years before that, you'll find that you generally did pretty well on a total return basis, and with the benefits of imputation and so on, when you gross that up on an after-tax basis, you do a bit better again. But it is a very, very wild ride. And so the question is, if your retirement portfolio is very concentrated and focused on a particular asset like property or Australian shares or any other asset class that's on the growth side for that matter, the question is, for the next 5 years or the next 10 years, is anything structurally or fundamentally different about the makeup of the world or the fundamentals underlying markets and so on that will mean that, given such a volatile asset class, do I need to do things a bit differently, given that volatility has picked up from historic lows and therefore brings into question, will you be able to survive the journey 5 years or beyond? And particularly we find that when we look at the average holding periods for mutual funds, not just in Australia but overseas as well, the average holding period is in the vicinity of 3.9 years on average for retail investors. So it's about surviving the journey as much as the end destination. Now, there's a couple of things we can do about this volatility and this how do we deal with it? One approach is what I call the bumpy ride, and that is very much trying to predict the next winner, but being aware of the human factor, which is something that we all have to consider as investors, basically stopping ourselves from making silly decisions on investing. Now, when I mention the human factor and trying to predict the next winner, there's a couple of behavioural traits that advisors logged in online at the moment will be very familiar with. One is overconfidence, humans tending to overestimate or exaggerating their ability to successfully perform tasks. And that comes back to the age-old question: if you ask someone, are they a good driver? 9 times out of 10, particularly if they're male, they'll say, I'm a fantastic driver, and so on and so on. Everybody in a bull market phase, particularly a bull market phase that has been far more extended than what was previously expected, bull market heroes are a dime a dozen. Everybody can be a successful investor, or almost everybody, in a bull market phase, because effectively what you have to do is buy an index or buy a stock, or a couple of stocks that generally give you a broad exposure to the market, and the market goes up. Overconfidence comes unstuck when we start to see volatility rising and we start to see turning points in markets which are far more volatile, and especially when we start to see a turn in the market phase. And overconfidence leads to things like trading too often. Herding behavioural trait, humans tend to mimic the actions of the larger group. This is called trend following. And this is very much one of the main behavioural traits that leads to buying high, selling low. We talk about, often talk about the cycle of investor emotions and how the very top of a market cycle is actually the point of maximum financial risk. Yet what we see typically around retail investor flows, not just in Australia but globally, is inflows into mutual funds in particular are at their highest around the peak of a market cycle, and redemptions are at their peak or at their largest around the lows of an investment cycle. In other words, buying high, selling low. And that's very much because being human beings, we have behavioural traits like herding that basically mean that I think this thing's going to go down, but the longer it goes and the longer it extends on the upside, it leads to this point of capitulation. It's like, oh, actually, you know what? I'm just going to get in the market in case I miss out. Likewise, on the downside, it's like it's time to buy. This thing looks really, really cheap. I've bought a couple of times now. This market is still falling. Actually, you know what? I can't take this pain anymore. It's time to capitulate, and I'll sell. The very next thing that happens, of course, is the thing you were looking for, the market to go up or the market to go down from the other side, actually happens. That's called whipsawing, and that's very much a trait of buying high and selling low, and causes a lot of problems and is quite wealth destructive. Familiarity, humans tend to prefer what is familiar or well known. In other words, we are overweight Australian shares. We have a very strong allocation to the markets, to the stocks, to the type of investments that we're very familiar with. Woolworths stock, we go to their supermarkets every day. Residential property, bricks and mortar, I get it, I understand it. I don't understand global equities, I don't understand Brexit, quantitative easing, all these quite complicated phrases and terms that you'll hear in the financial press and hear people like myself talking about is very hard to understand. So people stick to what they're familiar with. And while this can work at times and over a long period of time and a holding period, as we've seen with Australian shares and property, for example, it can get you there. The lack of diversification creates some real issues in terms of the ability to withstand the volatile ride along the way. And finally, mental accounting. Humans tend to separate their money into separate accounts. This is really about naive diversification. Mental accounting gets to the whole concept about play money, or I've got an inheritance, or I've won lotto, or you treat some parts of your finances differently to others. So it's like money you can afford to lose, that sort of thing. And that creates issues around naive diversification or getting into investments that are far too risky for what you're comfortable with. Just to reiterate that point, we do an analysis in the United States across mutual fund investors. So what we do here is we look at the Russell 3000 index, which is basically a broad market index commonly used in the United States. And over a period of time between January 1, 1984 and December 31, 2017, the US stock market, as represented by the Russell 3000, was up 11%. Then what we do is we look at monthly flow data, net fund flow data over the same time period. And then we do some calculations using a range of data inputs to generate the net return, accounting for mutual fund flows in and out of the average mutual fund investor in a passive product, so that we're like for like. And you can see that the average investor in the funds version of the market gets something like, gets just over 9%, 9.2%. So there's an annual cost to flipping and flopping or going to and fro in and out of the market, but over that entire period of approximately 1.8%. And when you compound this over a period of years, 1.8% doesn't sound that much, but when you compound that over a long period of time, 10, 20-year period, it can make a significant difference to the actual wealth outcome at your retirement goal. So that's so much for the bumpy ride, but what about the smoother ride? And this brings in the whole concept of diversification. So it's about staying invested in a diversified portfolio. So this graphic here looks a little complicated, but I'll just simply break it down for you. At the current situation, the blue dot in the bottom left corner is basically your starting point. So you either go into an advisor today, or you're working things through yourself. You're saying, this is my financial situation, my net worth, if you like. But given my retirement goals, my dreams, ambitions, what I want to achieve in retirement or over the next X number of years, the capital pool that I will need to have to generate sufficient income or sufficient capital release to live that way or to achieve those goals is the second blue dot, noted as goal. And joining your current situation to your future requirement is a rate of return, and it could be CPI plus 2, 3, 4, 5, 6, whatever the case may be. The blue line there, let's assume it's CPI plus 4. Now, the thing to notice about when you build portfolios is that there's many ways to the same destination. So let's pick on CPI inflation plus 4%. You can get there an extremely volatile way by just using Australian shares. And if I had to track the path of Australian shares, it would be very high outside of that grey shaded area, that grey sort of envelope, and very low outside on the bottom side below the grey shaded area as well. It would be quite a volatile ride, but you should generally end up with CPI plus 4 or above. The next thing is, the more diversification we bring in, the more we reduce the amplitude of the upswings and the downswings. So what the idea there is that by diversifying, you're reducing the swings and roundabouts, or improving the ride comfort of your journey along the way to achieving your outcome. And the smoother your ride, and the lower the lower the peaks and the lower the troughs, or the shallower the troughs, the higher the chance or the probability is that you're going to get to CPI plus 4. It's just mathematics. Is the way it works out. The smoother the ride, the more chance you have of achieving your actual outcome. And that's about risk control. So that's the whole rationale behind diversifying for a smoother journey. And the orange line there represents something that's a relatively new innovation in terms of products that are available, or approaches that are available to the retail market in Australia. They're called real return growth funds. I'll touch on those a little bit later on, just to give you an idea of how investors these days are starting to think a little differently about, all right, we've had 5, 6, 7 great years in particular of returns from the equity market. Now I'm a little bit anxious and a little bit worried about what's to come in the next period of time. What can I do about that to bank some of the profits that I've got, but have more of a focus on protecting what I've made so far? So we've seen on the checkerboard diagram, this is property, volatile, not as volatile as equities. But when we put these together in a multi-asset class portfolio with different weightings to all of these different asset classes that you can see on the screen, we end up with a profile of a 70% growth, 30% defensive portfolio that sits there just about in the middle. So it's still achieving the CPI plus 4, actually above that type of number over that period of time, but it's a far smoother ride. So the trade-off is, you don't get the highs of a very concentrated portfolio like Australian shares in 2009, for example, but then again, you don't get the lows of 2011 or 2000, where you're losing significant capital. So it is a trade-off. You trade off some of the stellar upside in response for getting far less of the awful downside. So that's, in a nutshell, the main findings that we have out of the 2018 Long-Term Investment Report. Now I'll turn to implications for Australian investors, because it's obviously one thing to look backwards, but I think it's more insightful to take what you can learn from the past and think about where we currently are in terms of investment markets, and then use that as useful information for how we want to invest going forward. And so the question becomes, does the experience of the last decade tell us anything about designing portfolios for the next one? Now, the general view that we have in terms of where we are in the investment cycle is we're coming into a very challenging period. And looking ahead, despite what we see in terms of strong returns in the past 10 and 20 years, meeting objectives is going to get much harder from here. And there's three big themes there. On the left, more downside than upside. We strongly believe we are at the mature stage of the particularly equity investment cycle, and particularly in the United States equity market. We still have expensive valuations in aggregate, but most of that is driven by a quite expensive still US equity market. Though that said, if you look around other parts of the world, and particularly with emerging markets at the moment, you find that even with China down more than 20%, parts of the Asian markets are actually in a bear market at the moment. If you were looking for reasonably attractive or even somewhat attractive levels of areas of investment, that would point you into areas of emerging markets and probably send you more to places like Europe and Japan and emerging markets, as opposed to the United States, which has been going hard for a very long period of time. So all that said, risk is very much skewed to the downside. Volatility is set to increase is the middle point there. We have had a historically unusual period of low volatility, and investors have to deal with the fact that that is not normal in the long-term history of equity markets in particular. And so what we saw in February is, and we've seen in previous little fits and starts in the last couple of years, but particularly in February, volatility has returned with a vengeance. And this is a hallmark of a late cycle market. We think we're in this late cycle, momentum-driven, expensive market. And what happens in these sort of turning points, or the start of turning points, which is very much what we see 2018 as, is you see a pickup in volatility. And the reason you see a pickup in volatility is because there's a lot of short-term positives, stellar earnings growth, backward looking in terms of US corporates and so on, momentum. Despite what happened in February, there's still big momentum-driven swings in equity markets, particularly in the States. And on the other side, we see developing big, large fundamental negatives arising in terms of fundamental things like yield curve slopes and a whole range of very technical and sometimes less technical things like inflation picking up and wage growth picking up, and what the Fed is going to do in terms of raising interest rates and so on. We see these two things at odds with each other. And so there's this pulling to and fro for investors. Do they listen to the short-term positives or the negatives, which are larger and on the horizon? And this debate is very much covers the 12 to 18 month time horizon. But what you'll find is that when we look beyond 12 to 18 months, what there is less debate about is that we are in for a period of lower returns going forward and higher volatility going forward over the next 5 years or so. And so you can imagine, and some on the webinar may be thinking about these aspects at this point, but we need real solutions for real client problems. So there may be some investors dealing with sequencing risk. In other words, you might be 57, 58 years old, between 55 and 60, say, pre-retirement. You cannot afford to take a significant fall in your asset base at the start of retirement, because if you get the big fall early, and we're not saying there will definitely be a big fall, but we are certainly looking at a skew of risk to the downside, which could be significant. If you get a big movement downwards at the start of your retirement, it has a big implication for your general ability to fund a lifestyle through the rest of your retirement. If you get a bigger fall later on in your retirement phase, that has far less of a significant impact. So you can see if you're just pre-retirement or about to retire, or even in early stage retirement, sequencing risk is an issue. And so that brings forward to front of mind issues around what can I do to protect some of the gains I've had and to reduce my exposure to the downside should it come. So the investment challenge is what I would put as follows. It's really about meeting the challenge to get what you need. So let's say, for example, we could use this across different risk profiles, but let's pick on a 70% growth, 30% defensive, balanced type of investor that needs inflation plus 4%. on average, through the course of a cycle or through their retirement to basically meet their retirement objectives. Now, if we break that down, our expectation over the next 5 years through the capital market modelling that we do, we have a global team that delves into this for every region. The average inflation that we would expect over the next 5 years, for example, is 2.4%. Now, if you need to generate a real return, in other words, a return above inflation of 4%, which is a pretty common objective for a 70-30 type balanced investor, you basically need 6.4% to get the job done on average. The issue is if we're moving into a lower return environment, and by lower return environment, I'll give you some idea as to how asset class assumptions have come down over the past 7 or 8 years or so. Back in 2010, just after the GFC, when assets were sold right down and a lot of asset or investment opportunities actually looked quite cheap, the upside was significant. And so what you needed at that point, given the return assumptions that were quite high at that point, after the GFC, you needed to generate an inflation plus 4% portfolio. You needed something like a 40% growth, 60% defensive or bonds type portfolio. March forward to 2017, and what you found is over that period of time, equity markets have rallied significantly. Even bond markets have rallied significantly thanks to monetary policy distortions from quantitative easing and so on. And so what we've seen is asset class expectations looking out 5 years on a rolling 5-year basis have come down significantly to the point where if you're looking at equities type of asset class assumptions at the moment, you're looking at between 4 and 6% on average over the next 5 years or so. If you're looking at things like fixed income or bonds, you're looking at between 2 and 3% on average over the next 5 years. If you're looking at things like listed infrastructure or listed property, which are subsectors of the larger equity market, you're probably looking at something more like 4. And if you're looking at things like high yield, which is sub-investment grade credit, you're looking at returns of, on average, something more attuned the 4 to 5% sort of level. So these numbers I've just been through are a lot lower than what they were back in 2010. And so in 2017, to make CPI plus 4, you would need an 85% growth and 15% defensive type of portfolio. So one of the very basic responses that you often hear to this sort of argument is, well, if the asset class return outlook is a lot lower, then surely I just need to add more risk into my portfolio to fill the gap. So the problem is that although we need CPI plus 4, what the markets will actually give us, if I just do a basic representative 70-30 portfolio of the main asset classes, I'll get inflation plus 2.1. I won't get inflation plus 4. That gives me a return gap of 1.9% on average that I need to get as close to filling, if not hopefully filled or more so, over the next 5 years or so. So this is the investment challenge. And the issue is, if you want to add more risk and find the highest returning asset classes, maybe going to chasing a double-digit return in emerging markets, for example, over 5 years, that comes with a cost. And it comes with far more volatility year in, year out, even month in, month out, than it is being in a diversified type of exposure. So if you want to be more concentrated to try and fill that gap, you've got a problem that you open yourself up to far more downside risk. And in a lower return environment, the more you lose, the harder it is to make up because the upside isn't as great as what it previously has been. So the way we approach addressing this return gap, say 2% or just under, is on the right-hand side here, critical success factors to bridge the return gap. So what sort of things can investors do, and whether it be institutional through to retail investors, there will be some combination of these 4 things. And because we're moving into what we believe is a lower return environment going forward, the next 5 years or more, it very much is centered on risk management, downside limitation, really trying to protect a lot of the great gains that we've had over recent years and not participate fully in the downside if and when it comes. So the four things there I've mentioned are dynamic management, downside limitation, additional return sources, and efficient implementation. The one that is most obvious and most accessible to retail investors is additional return sources. So can I find, say, alternative asset classes, or even inside traditional asset classes, can I find investment or return sources that are really lowly correlated to things like traditional equity markets or traditional bond markets? In other words, when they go down, I need something that's going to hold its ground or even make money, or increase its return, so that it will balance that out and help me fill that return gap. The ones that are, I'd say, less available or less used typically by retail investors are things like downside limitation, which is use of options. Certainly retail investors do use options, but the way institutional investors like us or like Russell Investments operate these sort of strategies, it's really about trying to take risk off the table without being run over if we're wrong. So in other words, if we're worried about a downturn in the markets and we want to reduce our holdings of a particular asset class, but it's so uncertain and so volatile at the moment that there is a meaningful probability that the market could actually keep going to the upside on a very momentum-driven rally. What we want to do is we want to reduce our exposure to, say, equities, but we don't want to risk leaving too much return on the table if the market actually goes the other way and goes north. So what we do is we try and get a skew in our return pattern. And that is, we want to skew our return pattern using things like options contracts and options strategies, so that we lose less on the downside than we make on the upside. And that is what's called getting a positive skew. And it doesn't matter, even if you're a retail investor or an advisor advising the retail clients, even if you're just looking at additional return sources, alternative investment sources, different ways of accessing traditional asset classes and so on, you're still trying to do that with a view to skewing the return profile. You're trying to reduce the amount of downside risk while protecting as much of the upside participation as you can. Dynamic management there isn't talking about whacking around portfolio shifts ad infinitum on a weekly or daily basis. That's not what this is about. When I talk about dynamic management, we are very much talking about dynamic risk management, and that is large, systematic changes in the equity market exposure in your portfolio as you go through the equity cycle. And I'll touch on this in a moment when we come to real return funds, because that's a particular characteristic of real return funds, which are often used by people who still need a growth return but can't stomach as much of the downside. And of course, for institutions, as it is for retail investors, efficient implementation, particularly in a low return environment, is as important as ever. So just to finish off, giving you an example. So we mentioned these four characteristics that on the previous slide that talk about how can we try and address at least some of filling this return gap that we think is more likely to happen over the next couple of years. We run a series of portfolios of a particular type that are different to your standard balanced funds or diversified funds, for example. And they don't replace balanced funds, but they are for a particular type of investor that has a heightened sensitivity to downside risk. It might be someone about to approach retirement. It might be someone early in the retirement phase. It may be someone who is running close to the line in terms of the pain threshold and really can't withstand a significant downturn in markets from this point in time. So real return portfolios or real return solutions exhibit hallmarks that I mentioned earlier, but I'll couch them in this way for you. They are outcome focused. So these type of portfolios are not peer relative. They don't actually look at what peers are doing, unlike you see in the retail balanced fund, conservative fund, growth fund type of universe. So they're outcome focused. Their sole focus in life is both return and risk. It's a multi-dimensional outcome. You need to generate CPI plus 4 with a tighter control on risk to make sure that you don't get any more than half the volatility of the Australian share market. So it's very much about reducing the swings and roundabouts, increasing the likelihood of achieving CPI plus 4, but with far less downside participation. What that means is, and the reason it's not a substitute for a conventional balance fund and so on, is that when you're in a bull market phase, these things will lag. Because they're just focused on a tight risk control around their objective, and they don't care what peers or anything else is doing. Their job is to deliver that CPI plus 4 or CPI plus 2 or 5 return. Dynamic management is the second element, which we touched on in the previous slide. Again, this is about larger systematic adjustments of market exposures and really about embedding that positive return skew that I mentioned with a tighter risk control. So dynamic management and use of downside limitation strategies like options are the ways that we get the tighter risk control to deliver that particular outcome that I mentioned at the outset. And of course, they still very much in line with the multi-manager core of a typical balanced or conservative or growth portfolio. There is real diversification across external strategies, internal strategies, different processes, different styles, these sorts of things, but particularly alternative assets, different ways to access different sources of return, which is really what we're going to need to try and fill that return gap that I mentioned earlier. Just quickly to give you an illustration, Dynamic Real Return Series has return objectives, again, the same as what you'll find in balanced funds and conventional funds, CPI plus 2, 4 and 5, depending on the risk profile that you have. But as I mentioned previously in that chart where I had the current situation, your goal and the journey, the swings and roundabouts between the two, you'll find that the difference here is all about the journey. So it's the same return objective as you'll find in more conventional funds, but you'll find that the volatility objective is a lot higher hurdle. So we only want half the ASX volatility in a CPI plus 4 type of strategy here, or we only want a third in a conservative one, which is what you'd expect from a diversified strategy, but still is very much less downside participation than what you get in a traditional balanced or conservative or growth fund. The drawdown risk focus, in other words, the focus on limiting any participation in downside, is high across all these types of portfolio solutions. And we also have a difference in income focus. So when you get to an inflation plus 2, that's what we call an income strategy, a real return income strategy. So you're still getting less downside participation, but you're still generating income, which to date has been in the vicinity of 4.5% per annum. So not that you'll get grossed up with Australian shares, but that's the trade-off for having a smoother ride and less downside participation. Just to give you some idea, disciplined systematic process is what is needed. And it's not just about Russell Investments. It's not just about these particular portfolios. When things get volatile for an institutional investor or any retail investor, the clearer you are on your decision-making process, the reason that you're invested the way you are, in other words, the investment strategy or wealth plan that you have, the clearer you are and the more disciplined you are in sticking to and executing that plan, the better off you'll be and the better the likelihood that you will successfully navigate a period of turmoil or a period of market weakness. The main thing that these portfolios, these real return portfolios do, is they look to significantly adjust the equity market allocation or your exposure to the share market through time. And you'll see in the middle there that back in 2013, this type of portfolio was more of a growth, and before that was even a high growth portfolio. And as we move through time, you can see there's periods where it's significantly reduced risk, down to 30% equities, for example, replace some of that equities with growth exposures in alternative assets, more recently through 2017, 2018. But you can see that it's systematically reducing equity market exposure as the equity market goes higher. And there's one simple reason for that, and that is the stronger the market, the less risk we have to take to generate CPI plus 4 or 2 or 5. So it's a very systematic approach, again, focused on a particular objective, and it systematically reduces equity risk, so that's part of not participating in the downside when a turn eventually comes. Just quickly, downside limitation, this backs up a previous point that I had. The less you lose, the less you have to make up in a lower return environment. So this is any student of financial statistics, or anyone who's done any in university and so on, be quite familiar with this. If you lose 10%, you need to make 11% back up afterwards to get to your starting point, and so on and so on. And by the time you get to 40, 50%, if you lose 50% in a down move on an equity market, if, for example, you have a very undiversified portfolio, you need to make a 100% return to get back to your starting point. The key lesson here is, and I think the key lesson for thinking about how you can structure your own portfolios going forward, if we're even half right about the lower return environment, is the less you lose on the downside, the less pressure there is on you, or the less requirement there is to generate a significantly higher return in a lower return world, which is going to be harder to do in, quite frankly. So that's why reducing the drawdown and the downside participation is not really just an issue for those close to retirement or early in retirement, but it's an issue for all investors, really, regardless of whether you're 40 years old or 45 or 50 or 35 or whatever. The less you lose in a lower return environment, the less you have to make back. And then just finally, real diversification. Again, this is just one example of a CPI plus 4 real return fund there that I've been talking about. But you can see conventional asset classes at the high level, but when you dig into the particular strategies, you'll find things like long-short funds, you'll find futures exposures, futures baskets. You'll find greater use of options. You'll find wider asset allocation ranges, and this allows you to basically take more risk off the table, and even re-add or add back risk, if I can say that, when the market turns upward again. So you'll find that at the moment it's a defensively biased portfolio at 50-50, low Australian shares for a number of reasons, but we've had a pretty good run in the last quarter or so on Australian shares, but Australian shares has been lagging significantly behind international shares, particularly because it's got lower exposure to tech stocks and healthcare stocks and so on, which global markets have. But generally, what you're looking for is this real diversification. We don't want to add new investments into the, say, alternatives part of the portfolio that are just going to exhibit very similar correlation or relationship to traditional asset classes. What we want are things in the portfolio that will be less correlated to traditional asset classes, so that if things do, it's quite the use of vernacular, hit the fan, we'll have something that will be holding its ground and staying up while other parts of the portfolio are coming off, thereby improving the ride comfort. So that's pretty much everything I wanted to go through, and then we'll open it up for questions. But I guess just to finish off, the question is, how comfortable is your or my or any investor's investment journey? That's the question we have to ask at this point. There are things that we can do to increase the ride comfort. Number one for most retail investors would be think about what's in your portfolio, how you can diversify across additional return sources, or even in traditional investment classes like equities and bonds. Is there a different way that I can access some of those return premia from conventional asset classes? So it's thinking a little differently about how you structure your portfolio. Maybe you're happy with holding a just completely ASX share portfolio, and that's fine. But if you want to bring some more, just a little more dynamic management or downside limitation into it, there are things you can do, including things like maybe adding an allocation to real return strategies and so on, to help navigate that turn in the market cycle, which we think is very much on the horizon. And given markets operate peak about 6 to 12 months ahead of actual turn downs in the real economy, it's quite likely that in 2019 we could start to see a different narrative very much sort of smothering the market or dominating the market going forward to what we have right now. So with that all said, I'll hand it back and take some questions if there's any.
Great, thanks so much, Scott. We've had a few questions come through. One of them, what is the difference between Russell Investments High Growth Fund and Russell Investments Multi-Asset Growth Strategy Plus Fund?
Okay. Yep. That's a very good question. Often it causes confusion when we're talking about multi-asset and growth and using the same words in different contexts. The Russell Investments High Growth Fund is more of a conventional suite of products with very much a aggressive risk profile there. So it is more constrained according to product disclosure statements. So there are smaller ranges. It is more tied to a strategic asset allocation, which is already set up. And it is very much run in a similar style, but just with a higher allocation of growth assets, as you would find in a conventional balanced fund or conservative fund. These are the traditional or conventional styles of high growth funds. The multi-asset growth strategy, CPI plus 5, for example, is what I've referred to as a real return fund. And that does not look at peers. It does not have a fixed strategic asset allocation. Its objective is to increase or maximize the likelihood of achieving CPI plus 4, but with a much tighter risk control around that CPI plus 4 return target than you would find in its conventional equivalent, the high growth fund. So it's very much a high growth version or high growth portfolio that is particularly suited to investors who have a higher than average sensitivity to drawdown or to making a capital loss and really can't stomach making a loss or going below their pain threshold. And again, I use the examples of particularly suited to people with issues around sequencing risk like pre-retirees, early retirement phase investors, and even anyone of any age or situation who is sailing pretty close to the line in terms of what they can afford to go below in terms of a capital value. So I hope that makes sense. They're the same outcome. It's just a very different journey. So the high growth conventional fund will have a larger variance in the upside and the downside, whereas the real return version that I've mentioned will have a much tighter control, lower upswings and shallower downswings.
Thank you. And what are the typical underlying investments in the real return funds?
So if you looked at the asset allocation chart that I had, you'll find that there's a range of conventional assets. So I'm just going to get the asset allocation. Can I actually flick back on this? If I flick back to the asset allocation here, that is the June 30 asset allocation of the real return fund, the CPI plus 4 version of it. You'll see things like Russell Investments this or Russell Investments that. That is effectively a multi-strategy fund that we have inside that fund. But really it's got a diversified range of external strategies in each line item of that fund. So for Australian shares, for example, you will find there'll be Australian share exposures in the factor exposure fund. There's a long-short manager, specific manager in there called Vinva that is there to take not only the long positions or bought positions in Australian shares, but also has an element of short in there. And what we're trying to do there is really diversify the way that the Australian shares return is generated. We also have options and futures there, which I've mentioned as ways to address downside risk and so on. In terms of international shares, we have developed market exposures across there. We have Asia Pacific emerging market exposures there, and we have a global emerging market exposures, including a small allocation to things like
frontier markets, which are the early stage emerging markets. It's a very diversified international shares exposure, but again, we have long-short capability in there. Inside the global opportunities slices, if I can put it that way, we also use a lot of quantitative type strategies. We use fundamental type strategies. We have managers investing in global shares using different styles. Again, this is about adding different sources of return or different sources of excess return and really diversifying the way we generate return, which is going to help us enormously in a lower return environment. On the alternative side, we also have commodity futures, which is really a managed futures type strategy. We also have emerging market debt, which means in local currency terms. Things like emerging market debt have taken a bit of have been hit pretty hard in the second quarter after a very strong first quarter. But you'll see emerging markets in the headlines a little bit. Emerging market debt is there as the type of strategy that we bring in, which has higher yield. It has a lower average maturity profile, which means that in a rising interest rate environment, you want to have shorter maturities. There's a lot more to it than that. But effectively, when rates are rising, you don't want to be increasing your maturity profile of any fixed income investment out to 10 or 20 years. You would rather have a maturity profile that was more in months and a couple of years because they're less sensitive to rising rates. So emerging markets fit the bill there because they have much higher yield than developed markets. Japanese government bonds, for example, for a long time in the recent past, have generated something like 0.03% for a 10-year investment. So it's, as a colleague of mine likes to comment, it's one of the worst investments in the world going around at that point in time. So what we need to do is diversify away from traditional sort of sources which are very low yielding, and we want to get into things like emerging market debt, but we don't want to do it in a way that's highly concentrated. We want to access these sort of markets and these sort of high yield opportunities in a way that's diversified with a whole range of other investments. And again, that helps give us a smoother ride along the way.
Thank you. And probably only time for one more question. What is the minimum investment in these funds?
Yeah, so
as per the Netwealth platform. As per the Netwealth platform.
Oh, as per the Netwealth platform, okay. So I believe it's about $10,000.
Great, thank you. And thanks so much for your time today, Scott.
My pleasure. Thank you very much for.
Sorry we didn't get to answer everyone's questions, but we'll try and get around to sending some emails back to you all. And thanks again for everyone who attended. And we hope you can join us for our next webinar next month. Thank you. Bye-bye.